Please let's have another round of applause. I think I'll add teacher, lecturer to another name that I'll be calling the founding partner. There was so much I learned. I mean, 1 million. Can you just fathom the opportunity? Some people see a problem, but that's actually an opportunity for us to deliver value and create wealth while solving these problems. Again, let's put our hands together for him. Next, it's my pleasure to invite our keynote speaker, who has traveled many miles and I believe has crossed several oceans just to join us here today. He'll be sharing from his wealth of experience as a pioneer in the Malaysian real estate industry. If you want to read about him, because I won't have the time to read his bio, I encourage you to open your brochures and just use your phone to scan the QR code. There you can read his biography, as well as the biographies of all our speakers, our moderators, and panelists. And trust me, you'll be blown away by the sheer wealth of knowledge that he possesses. So again, if your hands are not too busy, I'd like you to give him a Nigerian, rousing, warm round of applause. Please make welcome Mr. Rupan, an international housing finance consultant. I believe we can keep the applause going. Thank you so much for being here in Lagos, Nigeria. I know we're all waiting with bated breath to hear all you have planned for us. Please, you may take your seat. Thank you very much.
Good morning, ladies and gentlemen. If you don't mind, with your permission, can I just sit down and make the address? Because, perhaps it's because of the jet lag. I'm feeling a bit giddy, so I'd rather sit down and do the presentation. Thank you very much for your understanding. A very good morning to all of you, ladies and gentlemen, most distinguished guests. I would like to extend my thanks, first of all, to Mr. Fathimuddin, my old friend. I've known him for the last 10 to 15 years, and I can say very confidently that the description that the MC gave him was very, very apt. In addition to him, of course, I know Dr. Roland. Now, Dr. Roland is a good friend of mine, and we have worked together. And this morning, of course, I have met the gentleman from the Ministry of Housing Incorporated. He's the executive director, and he has shared some thoughts about housing industry in Nigeria. Now, first of all, I would like to say that I am not an expert in the African housing market. I really defer to people like Mr. Fathimuddin, Dr. Roland, and so on and so forth. And of course, I forgot to mention another name, my good friend, Dr. Kendi Mr. Kendi, who is the CEO of National Mortgage Refinance Company. Now, they are really the experts of the industry. What I would like to do this morning is to share some thoughts with you. Now, I don't intend to make this a monologue. I rather prefer to have a dialogue where we have answers and questions. But before that, I'll just do a short presentation. Now, initially, I was being told that my presentation for today will be on refinancing institutions as a tool for economic development. I met Mr. Fatimilin last night, and rightfully so, he came up with a brilliant idea. He said, look here, now refinancing is only one aspect of housing. Why don't you talk about the evolution of the housing market in Malaysia in general, and then go on to talk about refinancing, which I thought was a really brilliant idea, which came out from him. So thank you very much, Mr. Fatimilin, for your advice. Now, I really did not prepare any slides on the evolution of housing because that was not the topic given to me. But nevertheless, since I am familiar with the industry, I think I can just talk offhand. Just for your information, I have been in this industry for the last 40 years. 5 years, I have been in the primary housing market. I was the special assistant to the chief executive officer of Malaysia Building Society Berhad, which is a leading housing finance company. And when Chagamas was set up in 1986, I was invited by my ex-colleagues from the Central Bank of Malaysia, because I was from the Central Bank of Malaysia, to join the company. And the rest is history, of course. And lately in 2016, I was invited by the Central Bank of Pakistan to come and set up the Pakistan Mortgage Refinance Company and to operationalize it. So I was in Pakistan for 2 years. Now, without much ado, let me delve into the subject of the evolution of the housing market in Malaysia. Now, if I may trace the history, the housing market of Malaysia goes back to the 1960s. Since 1960, the policy of the government or the dream of the government was housing the nation or housing everybody if possible. Since then, a number of steps have been taken by the various stakeholders. The prime mover of housing in Malaysia was really the government. The Central Bank of Malaysia played an equally important role. And in the government, there were two agencies which were responsible. One was, of course, the Ministry of Housing. Housing comes under this ministry directly. And the other was the Ministry of Finance. Now, since 1966, we have been having 5-year Malaysia plans. The latest is, of course, 2021 to 2025. We have the 12th Malaysia plan. In every Malaysia plan, there is a chapter devoted to housing for the next 5 years. And this essentially talks about the targets, what are the things that the government intends to do, how it intends to promote housing. Now, initially, when housing started off in the 1960s, it was moving at a very slow pace. The banks were not active. The only two institutions that were active in housing finance were two building societies, namely the society from which I came, Malaysia Building Society Berhad, and there's another one known as Abonia Housing Mortgage Finance. The banks were reluctant to get into this sector. And the government was trying to push for housing. And in particular, even as way back in 1970, the government was aware of the plight faced by the vulnerability group, the low-income group. So there was a big push by the government to promote low-cost housing. And the way it was done was that the Ministry of Housing from 1974, I think, came out with a regulation for developers requiring each of the developers who develop housing to allocate a certain percentage of the allocation for low-cost housing. And the price of low-cost housing was fixed by the government. In other words, it's a kind of a cross-subsidy for the developer, right? So they have got to actually sell these houses at the fixed price, and they have to build a certain portion. If they don't meet the requirement, then they will have to, when they undertake the next project, the government will forfeit it and they will have got to add on these units. At the same time, this is on the building aspect because developers were never interested in getting into the low-cost housing. So the government had to actually push it, right? Although, of course, in the World Bank, my colleagues always tell that, well, you know, government should not get involved. Government should only play a facilitative role. But my own personal view is that when a country is in a nascent stage of development, or where housing is in a nascent stage, the government has a very, very big role to play. And even today, the Malaysian government plays a big role. I'll explain to you later. Now, so when the government actually set up quotas for low-cost housing to developers, the central bank played its part in terms of financing. As I told you, banks were reluctant to get into this field. So the central bank had what is known as a priority sector financing. The priority sector financing consists of agriculture and housing. And if I'm not mistaken, 10% of their total loans should be given for low-cost housing. And the interest rate was also fixed. It was 1.75% above the base rate of the banks. And if the banks do not, each bank was given a quota by the central bank. If the banks do not meet this quota, that money will be frozen with the central bank in statutory reserves. That means they won't get any interest, right? So there was incentive for the banks also to give housing. This is the history of housing, how low-cost housing started off in Malaysia. Now, as we progress along, we encountered another situation. As you know, in Malaysia, we have been very fortunate. We have been enjoying low interest rate regimes. To talk about double-digit inflation is something which is really unthinkable in Malaysia. So somewhere in 1980, interest rates shot up. And when interest rates shot up, the banks were reluctant to give financing for housing. So the central bank initiated a study of how to set up a liquidity facility, which is known as Chagamas today. The central bank got a team of people consisting of the Association of Banks, and there was Association of Finance Companies and Merchant Banks. These are all players in the industry to come up with a study. This study was done in 1982, I think. The first report came out. But at that time, the central bank thought it was not timely to set up a secondary mortgage market. In 1986, banks were again were reluctant to give, and the central bank indeed set up a secondary mortgage market liquidity institution known as Chagamas, and Chagamas was incorporated in December 1986. And at that time, the CEO of the company was seconded from the Central Bank of Malaysia. Now, and the purpose of Chagamas is very similar to that of NMRC. Essentially, it is looked at as an institution which provides liquidity and hedging for the banks. So its primary purpose is to provide medium to long-term liquidity at reasonable cost to the banks to enable the banks to give long-term housing loans to the borrowers at a reasonable price. Now, as you know, in all these countries, right, now affordability is the big issue. Now, one way to increase affordability is, of course, to lengthen the maturity of the loan. So the banks at that time, before Chagamas was established, were giving loan maturities ranging from something like 7 years to 10 years. But after the establishment of Chagamas, because they were so confident that they can get funds from Chagamas, they started out giving loans up to 15 years, 20 years, 25 years, and even some banks went to the extent of giving second-generation loans. Today, there are banks who are giving up to 35 years, provided, of course, your age at the end of the repayment period does not exceed 70 years, right? Now, so Chagamas played a very, very critical role in establishing the housing market, in the housing finance market in particular, in Malaysia. And I can tell you frankly how we did it. Now, we had the full support of both the government and the central bank. The governor of the central bank was our chairman, and the Ministry of Finance was very supportive. The central bank held 20% equity in this company, and the other 80% was held by all the banks. That means it is more or less a cooperative institution. serve a public good. And the way we started operations, very unlike other mortgage facilities, because we were the first to set up. We did not call the World Bank. We did not call anybody. It was homegrown. What we did was we said that, look, at first, in fact, to be honest with you, before I joined this company, I had a CEO from Bank Negara, the central bank. I think he visited US and all that. And he was so taken up by the Fannie Mae model. So when I joined in, he was the one who recruited me. He was talking about it. And I told him, I said, look here, sir, people in this country today do not even know how to spell securitization. Let's forget about this securitization. We should do something which is very simple. Let's follow the FHLB model, Federal Housing Loan Bank, as you know, right? So we actually did it ourselves. We purchased the loans with recourse. We didn't have any World Bank funding. Now, from day one, we got into the bond market. We did not have any funding at all. We only had a seed capital of, I think, 10 million Malaysian ringgit, which is close to 3.5 million US dollars. And of course, our paid up capital from the banks was 50 million Malaysian ringgit divided by 4, which is roughly about 12 to 15 million US dollars, right? We went into the bond market to issue bonds for 3 to 5 years. And we were very successful. The price that our bonds fetch were only 30 basis points above government papers. That means we were treated as a quasi-government paper. No government guarantees, no central bank guarantees. We were set up as a solely private sector institution. And honestly, we owe this to the central bank. It was because of the regulatory treatment that was accorded to Chagama's bonds. The bonds fetch a low value. The investors had confidence. Now, I will get into the details of the regulatory treatment which is given because that is a very important aspect. And of course, we started off and we said, yes, you know, in fact, our charter says we are supposed to provide long-term funding. But let's be very practical about it, right? Now, I am new in the bonds market. At that time in Malaysia, the capital market was a nascent market. The only bonds that were there were government bonds. In fact, Chagamas can be considered as the forerunner of the corporate bonds market. So we said that, look here, we don't have any history in the bond market. If we were to go, we will get whacked. And if the price is too high, the banks will not play. And it will be a futile exercise because we are not fulfilling our objective of passing on low-cost funds to the banks. So we said, let's do it another way. What we will do is we will do 3-year bonds first. With the option, we give this 3-year fixed rate funds to the banks with the option of rolling over for another 3 or 5 years, depending upon the growth of the bond market. And the banks are very confident then because they can give a 25-year loan, knowing pretty well they can come to us for a 3-year refinancing, purchase with recourse. At the end of the 3 years, we'll give them another 3 years or 5 years, whichever they want, at a fixed rate. And they can change the pricing to the customer. Because it is just not possible for a developing country like Malaysia, or even for that matter, Nigeria today, to give a fixed rate for 25 years. Our bond markets are not liquid, unlike the US bond market, of course. So we need to actually tranche it. And this was a very successful strategy. And even today, Chagamas has been in operations, I think, for about 35 years. The demand, Chagamas is only issuing bonds 3 to 5 years, not more than that. And the reason is very simple. The banks are very happy with it. And the banks are happy because nobody wants to lock in for a period of 25 years because interest rate has got its cycles. They move up and then they move down. If I am locked for 25 years, if interest rates move down, I'm going to be at the losing end. So Chagamas, what we did was we came up with not only a fixed rate product, we also came out with a floating rate product. Floating rate means we can float based on market interest rates. And we also had another variation called a convertible, which is fixed and floating. The banks can choose. So banks were very happy in a sense that when banks saw that rates were going up, they will lock in with us at fixed rates. When they think banks rates are going down, they will lock in, they will come for the floating rates. So they don't lose, the borrowers don't lose, nobody loses. And Chagamas doesn't lose because we raise funds from the capital market. It's a more or less like a cost plus thing. We just add 20 basis points. That's all. We only had 20 to 25 basis points as our margin because our philosophy was we should not depend on pricing, but we should depend on volumes, right? And the market grew. So this is basically the history of Chagamas and the mortgage and the housing market in Malaysia. Now, today, as I talk, the government is still playing a very important role in housing. There are at least 15 government housing programs in Malaysia today. Now, I don't have to go through this in detail because if you just Google and see government housing programs in Malaysia, you'll see all these 15 programs. And they are all meant for targeted groups. It's mainly affordable housing. And some of these loans are given with a mortgage insurance. And Chagamas is providing the mortgage insurance, right? I'll explain that. So in a nutshell, I will say the importance of the role of the government in providing and support to this industry is very, very critical, right? This is my experience. And I always say that, you see, all of us, I'm sure that in this audience, distinguished audience, many of you are actually very passionate about promoting housing in Nigeria, right? But what is going to make the difference? To me, the difference will be made by the government, the political will. If there is a political will, there is a way to do it. And today I'm fortunate to meet the gentleman who is the executive director of the Ministry of Finance Incorporated. I had a brief chat with him and he seems to be very, very knowledgeable in the industry. And from my half an hour interaction with him, I can see the passion that he's having in promoting the market. And I think it's good to have people like this who are competent, who are passionate in the government, who can push for housing. And I would, in fact, I told him that if he needs any help, he can write in to me and I can put him to the right people in Malaysia, people who are very knowledgeable, more knowledgeable than me in the housing industry. And of course, I can put him together with the others. Now, with that, gentlemen, I will now go on to my presentation and you are free to ask any questions later. The slides. Not working? Can someone help me with this, please? Okay. Okay, the topic for today is mortgage refinancing as a tool for economic development. Now, I am supposed to cover essentially the role of MRCs in housing finance. The role of MRCs in housing finance, the kind of products that they can develop, the role of the central bank and the government, as well as more importantly so, the role of MRCs or mortgage refinance companies in the capital market. Because we must all bear in mind that the source of funding for mortgage should come from the capital market, because mortgage is a long-term funding and you need long-term funds. You cannot fund by deposits because you're going to have a big mismaturity risk as well as a liquidity risk. Now, however, in order to talk about the mortgage refinancing company, I think I should spend a little bit of time talking to you about the primary mortgage market as well as housing developers, because I'm always having a problem with this. Yeah. Oh, I've got to direct it this way or this way. All right. Oh, good. Okay, the housing situation in Nigeria, of course, you all know about it. So I'm going to skip this. This is very useful. Now, okay, this is the premise, the value chain in housing finance. Now, housing finance can only exist if these 4 blocks are put in place. There must be developer finance, mortgage finance, and a secondary mortgage market institution. And more importantly, there has to be a capital market. The capital market is the institution that provides the funding, long-term funding, to the secondary mortgage market institution in order to provide long-term funds to the mortgage finance institutions. Now, developer finance. Now, in most countries, I have worked in Pakistan, I have worked in Tanzania, Egypt, a couple of countries, including Malaysia. Now, I find that one of the common characteristics is that the banks seem to be reluctant to give developer finance. And the main reasons are, it runs across. The first reason is, of course, they do not have trust in the developers. The developers don't have a track record. Some of them don't have deep pockets. But what is really lacking is the trust with developers, because in some of these countries, there have been nasty experiences where projects were left abandoned. Developers were not able to complete it. And there were just a few black sheep in the industry in some countries where they just took the money and they fled, right? Now, this was the same experience in Malaysia. So what we did was, in Malaysia, in 1960 itself, the government came up with what is known as the Housing Development Act. The Housing Development Act is a very important piece of legislation which regulates the activities of the developers and protects the consumer's interests. So by virtue of this act, developers are licensed. They have to follow certain rules. They have to put in a certain amount of capital. And there is a standard sales and purchase agreement. There is a standard completion period. If they don't complete it in time, they have got to pay indemnity to the borrowers. Standard and purchase agreement is standard because we do not want the borrowers to actually incur costs by going to the lawyers to draw up different kinds of sales and purchase agreement. And the best thing is that if a developer abandons a project, it is considered as a criminal offense. Unless, of course, he has got valid reasons as to why he has to abandon. And if he abandons it, the government will step in and get another, or liquidator will step in to get another person to develop the property. Now, this piece of legislation, which was there in 1965, of course, when it started in a very raw form. But over time, we found these issues of abandonment, housing, and all that. So we refined this act. I think it went through no less than a refinement of 7 times. Today, we have the latest one, which is the Housing Development Act 1915. You can Google at it. And this piece of legislation gave confidence to the banks to give developer finance. So the developers started giving developer finance to the banks. Now, when I went to Pakistan, I faced a similar problem. Banks were not prepared to give developer finance. So even long before I went, the Pakistan authorities have been working on what is known as the Real Estate Regulatory Authority, which is really, I would say, a brief version of the Housing Development Act, where it standardizes housing development, but it's a good start in any case. And that was modeled after India, because India also had a similar piece of legislation. So one of the things which I suggested was that perhaps they should go strong and implement this real estate regulatory authority so that the banks will have greater confidence. And of course, Pakistan has done it now. And because of this, the banks are also now prepared to give loans to developers. Of course, very selective developers, but at least those developers with track records are able to get developer finance from the banks. Now, institutional framework for efficient mortgage finance. Now, this is very important. Now, this is just, it is not applicable really to Nigeria, but it's a very generic one. Now, as you know, in a nutshell, there are various ministries which are responsible for housing. All that this slide tells you is that there should be close coordination between all these agencies. The trouble we find is, in most countries, at least through my limited experience, I find that the left hand does not know what the right hand is doing. So there's very little coordination, as a result of which there's overlap and sometimes even duplication and bureaucracy. And this delays the whole process. And I'm fortunate that in the case of Malaysia, there was very close coordination between the various agencies. And that was one of the success factors for housing in Malaysia. Now, issues relating to mortgage finance. Now, all governments are committed to provide robust housing finance system because in most countries, as a young population, the demography is young and people aspire to own houses. And of course, owning social housing, owning housing is a form of social security, even for the government, so to speak. Now, population growth coupled with urbanization has accelerated the need for affordable housing. However, in most emerging countries, the trend is housing finance is underdeveloped. They are largely deposit-based. They are expensive. They are small and poorly accessible. And lenders are faced with credit, liquidity, and interest rate risks. And of course, borrowers are faced with interest rate risks. Now, what are the ingredients for efficient financing market? Now, you all are familiar with it, so I don't intend to dwell. The basic ingredients are, of course, there must be stable macroeconomic environment, a competitive market structure. And I always say that, you know, subsidized housing is not sustainable in the long run. In the long run, we have to find a solution for market-driven housing. Having said that, subsidy will still be a very important component of housing for the government, but it must be targeted carefully so that the right groups get the subsidy. Right? The mortgage instruments should be standardized. That means all your documentation should be standardized so that the borrowers don't have to go through the hassle of going to the lawyers and drawing up different sets of documents. And, you know, this costs money. Number two is that it may also be subject to disputes later. So there must be a standardized agreement for all these mortgage instruments. Of course, needless to say, prudent origination techniques, underwriting skills of the banks are very important. This has become even more so important now in the volatile market conditions, because as you can see, when interest rates escalate, the tendency is for defaults to escalate. So I think central banks are also now mindful of it, and they are quite stringent in terms of the underwriting requirements. And of course, good servicing techniques. Now, servicing techniques is one thing which I would like to emphasize because we have experienced this. Now, you see, what happens is that you may have the best underwriting practices, but when it comes to a recession, which is well beyond your control, your default rates may go up, right? So the bank must be very proactive as far as defaults are concerned. You must not wait until the loan becomes 3 months in arrears or 6 months in arrears. You should start from day one. The best way to bring a defaulted loan to normalcy is to talk to the borrower from day one and try to reschedule the loan rather than leaving the loan to become in arrears for 3 months or 6 months, because by which time it may be too late to reschedule the loan. Now, I have had the personal experience in this, in a sense that when I was working in the primary mortgage market institution, in 1985, there was a recession in Malaysia. So the loans, we had very high default rates in Malaysia Building Society. So the chairman at that time came and told the CEO, you got 4 senior guys, deploy them to the branches. Each senior guy will cover 3 branches. So I was deployed to the worst 3 branches, which is the East Coast. Default rates were very high. And what I found out was that essentially what the branch managers were doing is they were just following head office procedures. That means they are just taking actions based on the head office procedures. Once in 3 months, you send the notice, then you send the legal notice, so on and so forth. Now, this really doesn't work in such a situation. So we went there and we said, look, this doesn't work. We have to do something else. The best way is to actually talk to the borrower, try to reschedule. And so we called the borrowers, we rescheduled the loans, and we were successful to a certain extent. There were people who were in 25 months arrears, in fact, and they were prepared to come and talk to us. Some borrowers need a moratorium. Some borrowers need rescheduling. There are various techniques that you can adopt. So early action in terms of default is very important, not only for the bank, but also for the industry as a whole and for the confidence of the industry. Now, what are the models for mortgage finance? Essentially deposit-based, traditional model, very bad model because deposits short-term, housing loans long-term. Then you have liquidity facilities, Nigerian Mortgage Refinance Company. You have covered bonds, you have securitization. Now, the first step is really to get into a liquidity facility. Now, covered bonds, securitization are more complex. They require legislations. They are more expensive. They need credit enhancements. So in all countries, the first step is a liquidity facility. And the liquidity facility later can act as the forerunner for either covered bonds or securitization. Right? So it's a simple second-tier institution. It either lends or purchases collateralized loans with recourse to the banks. That means credit risk is still borne by the banks. It acts as an intermediary between the banks and the capital market, issues simple bonds, and is a monoline, low-risk, simple institution. This is the key word. It is monoline, low-risk, simple institution. So as far as possible, the risk management practices of this institution is extremely important. Now, this institution will act as a stepping stone between the primary lenders and the capital market. And there is no such thing as a one-size-fits-all. It has to be tailored to the needs of each market. Now, what are the benefits of MRC? Now, you all know this, right? Now, first of all, lenders can obtain medium to long-term funds, right? It reduces the maturity mismatch risk as well as the liquidity risk because they can obtain funds from this secondary market. It enables them to provide fixed rate loans, enables borrowers to also get fixed rate loans. It lowers the cost of funding. It promotes sound mortgage market practices because the liquidity facility will set up eligibility standards. And these eligibility standards is actually to set up good, sound mortgage practices because the banks will follow these practices because unless these loans qualify these criteria, they will not be eligible for refinance. And it also increases the range of institutions which are able to provide housing finance. Now, as you know, banks can provide because they have deposits. But what about non-deposit taking institutions? Institutions such as housing finance companies, for example. Some housing finance companies don't take. So where are they going to get their sources of funds? The liquidity facility is the answer, so they can obtain. And one of the things which we did in Pakistan as well, we said, look here, the banks are really not interested in this area because that is not their bread and butter. Here you have, of course, the mortgage banks. So we set up housing finance companies, and the housing finance companies do nothing else except purely concentrate on housing loans. That's about it. Single monoline business. Now, MRCs are also, as I mentioned earlier, forerunners of the corporate bond market, and they stimulate the bond market by offering various types of bonds with various maturities. Now, the vision is very simple. Vision of all mortgage markets is to promote home ownership. The mission is basically, there are two primary missions. One is to develop the primary mortgage market. The next one is to develop the capital market. So you can see the visions of Chagamas and in fact, even NMRC as an attachment later. I'm not going to dwell into it. But what is important here is that all liquidity facilities have these two missions. They have two missions. One, the primary mortgage market. Number two, the corporate bonds market. These are the two missions of a liquidity facility. Now, the Nigerian Mortgage Refinance Company, it was established in 2013. You all know about it. Now, I read the annual report. It has got good governance, a very competent board, very competent management. I know Kendi very well. It's a very competent and proactive gentleman. It's also a very lean organization. This is very critical. Liquidity facility should not be overstaffed because we are a wholesale institution. It should be as lean as possible. And this is how Chagama started off as well. We only had about 23 to 25 staff initially. Now, they were given, the World Bank has given them a loan. And in addition to that, NMRC has also successfully issued, I think, 3 series of 15-year bonds. But these bonds are all guaranteed by the federal government of Nigeria. Right. At the end of 2021, their mortgage loan outstanding was 21 billion. They have a very strong balance sheet. And of course, 57 billion was invested in government securities. Of course, I could see one of the reasons because, as you know, the main function of a mortgage refinance company is actually to provide refinancing. In this case, it is not the fault of MMRC. I know NMRC has been working very hard. They have taken a lot of steps to develop the market. Probably the reason why the volume is low is because there are not enough loans in the market. So the solution is how do you increase the loans in the market, right? Now, these are, of course, some of the commendable achievements of NMRC in removing the barriers. Well, you are very familiar with it, so I'm not going to go through that. Now, the characteristics of any MMRC. Now, always bear in mind this, right? When a liquidity facility is set up, there are 2 important characteristics. One is financial stability instrument. It acts as a financial stability instrument. In other words, it is a policy tool for the government to promote its housing program. Its mandate is development in nature. Profitability is not the prime objective. ROE is not the prime objective. The prime objective is development. Of course, it has to make reasonable profits in order to be sustainable, but it should not be profitability at the expense of development. Now, and this facility, as you know, why does it act as a financial stability instrument? All central banks would like to see there are no maturity mismatches in banks. Now, if there are maturity mismatches, you know, havoc. When interest rates go up, you can create real havoc to the bank. The banks can even fall. Now, a recent example is the banks in US, right? They were holding long-term bonds. And when interest rates started rising, they actually were not able to get rid of these long-term bonds. So they want to reduce maturity mismatches. And this MRC is one of the policy tools that they use to reduce the maturity mismatch of a bank. Right. The risk profile of this institution is also a very low risk profile. That's why, as I mentioned earlier, if it issues a bond, it is given near sovereign status for the bonds. And this actually becomes attractive to the mortgage lenders. It has institutional support. And of course, as I mentioned, it acts as a policy tool. So what are the ingredients for the effective functioning of a liquidity facility? Number one, prudential regulations. Essentially, these regulations are set by the central bank. Now, one of the things that we have to be careful and mindful is that mortgage refinancing company is really an outlier institution. It is not in the mainstream of the banking industry. So central banks sometimes in their eagerness to set rules, apply the same rules that banks are supposed to be subjected to. Now, if you apply these rules, these institutions will fail. You cannot apply those rules. The rules have to be modified. So in most instances, central banks have modified the rules to suit this kind of institution because it is basically a low-risk institution. Now, this is the critical part about any liquidity facility, the regulatory treatment given to its bonds. Now, in the case of Chagamas, when we start off, the risk weight for the banks for bonds was 10%. It was considered as a liquid assets. The mode of issue, now because we're new, there are principal dealers who have to bid for government bonds. So these principal dealers were asked to bid for Chagamas bonds as well. So they bid for Chagamas bonds. So we never had this problem of undersubscription. And of course, there was a dealer network which was set up by the central bank. Now, sometime in 2004, if I'm not mistaken, Chagamas matured. Chagamas was able to stand on its own feet. So the central bank said, okay, guys, now we will have to take off some of this regulatory treatment because the regulatory treatment is given always with a sunset provision. So the regulatory treatment was then strengthened to 20% risk weight, and it was classified as class 2 liquid assets and so on and so forth. But the important point to notice, when an institution is at its nascent stage, it is important to give this so that it can establish its name in the capital market. Once the name is established, the institution can then stand on its own feet and the government can slowly withdraw these concessions, right? And these concessions, mind you, don't cost a single cent to the government because whatever concessions that you are giving, you are not giving it to the secondary mortgage market institution, but you are effectively giving it to the buyers of housing loans, because these privileges or so-called regulatory treatment enables this institution to obtain low-cost funds, to pass these low costs to the banks so that the banks can give loans at low mortgage rates. So always it's good to understand that the regulatory treatment is for the benefit of the ultimate home buyers and not for this institution. Now, in the case of Pakistan, now when I went to Pakistan, of course, I had a very tough time convincing the central bank, but they gave the same regulatory treatment as Chagamas got. And I can tell you something that Pakistan, the PMRC was set up in 2019. And I came off and it started operations in late 2019. Today, it is the single largest issuer of corporate bonds in the market. And the reason is simply because of this regulatory treatment which was given, and is able to issue corporate bonds and sukuks. And one of the things which I emphasized was, you see, Islamic loans. Now, there is a tendency for people to overlook the importance of Islamic loans. But this is a very critical element, because when you issue a sukuk, I find that the sukuk will cost you less than a conventional bond because of the wider coverage. So when I was supposed to set up Pakistan Refinance Company, I told the deputy governor, I said, we have to work on two fronts simultaneously, conventional and Islamic. And this is what we did in Chagamas. In fact, in Chagamas, we were the first to issue the first Islamic residential bonds, securitization of the first Islamic residential bonds, right? So this regulatory treatment is extremely important. Now, since I'm running out of time, I'll just go through quickly so that I can leave the rest of the time for questions. Ownership structure is also important. Sound risk management practices. Now, what are the variations that liquidity facilities can introduce? They can offer loans at fixed rate, floating rates, convertible rates. And what are the products they can do? They can refinance conventional loans, Islamic loans, offer loans for different tenors, not 15 years, maybe start out with 3 years, 5 years, 10 years, right? Progressively. Risk sharing facilities. Risk sharing facilities introduced in Pakistan, very popular. PMRC is the trustee. Banks were not willing to give for low income housing. We have a risk sharing whereby PMRC takes 40% of the risk, 60% taken by the banks. It was a hit. The World Bank gave 10 million, sold out. Now the World Bank is pumping in another 50 million. And low cost housing is taken off because in Pakistan, just like the government of Nigeria, the government of Pakistan wanted to build, I think, something like 1 million houses. So in order to support the government's program, the risk sharing facility becomes very important. Mortgage guarantee scheme. Chagamas has a mortgage guarantee scheme where banks can give 100% loans for certain sectors, and Chagamas will take the first loss of 10%. Of course, Chagamas has now even come up with reverse mortgages, which is basically to cater for the aging population. Product innovations. Now, MRC can have tripartite agreement between developers, the MRC, as well as the banks. So you enter into an agreement, you give a pre-finance loan to the banks, MRC gives a pre-finance loan, and the pre-finance loan is backed by government securities because they don't have any loans to give to MRC. The bank in turn gives then to the developers housing finance. In 3 years' time, this will be repaid, and the banks would have built up their portfolio of mortgage loans, and the bank then gives these mortgage loans to the MRC and takes back the government loans. This is a very successful model. And of course, the other important thing is to partner with the government in its housing finance programs. Risk sharing facility is another one. The other important component is green housing. Now, I don't have to emphasize, because of climate change, as you know, the vulnerable groups are the ones that are adversely affected when there is climate change. So we need to promote green housing. Funding instruments, you can issue fixed rate bonds, floating rate bonds, sukuks. Now the bonds can be tranched. You can do interest rate swaps if there's a swap market. And importantly, you can do the blending of the funds. That means generally the World Bank gives a loan at concessionary rates. What you do is that you go and issue a bond in the market because you want to establish your name, and you blend the funds so that the cost will be lower. Preconditions for success: support from government and central bank, support from the regulator of the capital market, shelf registration system, whatnot, good governance, sound risk management practices, good rating, being agile and meet market needs, work closely with stakeholders, willingness of lenders to refinance your loans. Central banks should have a policy on ALM for banks, and there are sufficient investors with a good appetite. Now, with that, ladies and gentlemen, thank you very much for your attention. I'm sorry I have passed my time. Can I have just 2 questions, or how do you propose to go about it?
Okay, we'll take one from the floor and maybe one virtually, but please we'll ask that you keep your questions very short and straight to the point. No time for contribution. So the microphone will go around. If you could just raise your hand if you do have a question. And the first hand I see will get the mic to you. Please note that during tea break, you can always walk up to Rupan, and I'm sure he'll be happy to share of his knowledge if there's anything that you'd like to ask him or maybe give him feedback. But we're looking at time. So a quick note to our moderators, please, you'll have to keep to time. I'll be the host, the compere, but also the accurate timekeeper. And at certain points, we'll have a note just passed to you, just in case maybe you've forgotten what time you have. So please, all the questions, the engagement, the discussions, all have to be within the time frame. We're really behind schedule, so please, let's keep to time. So if we do not have any questions online, or do we have any in the room one more time? Or you'll prefer to maybe walk up to Rupan and have your question? In the absence of any questions, we'd like to present a gift bag, a token of appreciation to our keynote speaker, and would like to invite our founding partner as well as the head of practice to join him on stage, and for the media and the photographers to also capture this moment. So please, if we could have our founding partner, sir, and the head of practice just join our keynote speaker. I think the applause is a bit weak. As the event proceeds, I'll be doing some recognitions. I want to welcome everyone who has joined us during that keynote presentation, physically and virtually, once again to the Dia Fatmilein and Co. 40th Anniversary Commemorative Conference. It's themed Scaling Up Real Estate in Nigeria. And we have 3 panel discussions. We've just had our keynote presentation. Earlier on, we had our opening remarks from the head of practice, as well as the founding partner. So we have 2 panel discussions. Then we have our tea break, our 3rd and final panel discussion. And of course, we'll be unveiling our new identity or refreshed identity, as well as the winners of the essay competition. We will be keeping to time, so we won't have the time to read out everyone's biographies, but those just joining us, you can bring out your phone, bring out the brochure, scan the QR codes, and then you can read up on all our speakers, our moderators, and our panelists. So please do that while you have time. And for those who just joined us, let's put our phones on silent mode. I think it's a good time to show with a round of applause your appreciation for that wonderful, very concise, and thorough keynote presentation. Once again, let's make welcome and really appreciate our keynote speaker, Rupan. As we prepare for our first panel discussion, we'd like you to share your pictures and videos using the hashtags of the day. You can see them on the screen, DFC40 and DFC Limitless Possibilities.
Thank you, Rupan. We are so enthralled by your detailed presentation. But there's something you failed to tell us, how Malaysia climbed to be a medium income country with the penetration of the mortgage market. That the percentage of penetration in the GDP is about 34% today. And in Nigeria, we are 0.5%. How can we move quickly to that level? Thank you. I'll bring this to you.
Thank you very much. I think that's a very, very pertinent question. Now, I think, as I mentioned, there were 2 basic factors that helped push the mortgage financing to 35% of GDP. One was, of course, the role played by the government, but that alone was not adequate. The second most important factor was the establishment of Chagamas. Now, when Chagamas was set up in the early years, I recall this very distinctly, we were set up in 1986. In 1990, the ratio of housing loans to GDP was, I think, something like 9%. And this grew progressively over time because the banks were prepared to give housing loans to the borrowers because they could get funding from Chagamas. And Chagamas was the prime mover of getting the mortgage market moving. And that's why I think that NMRC here has got a very important role. It's a very important institution. And I'm quite confident that NMRC will be able to fulfill this role in Nigeria. Thank you.
So by extension, if Nigeria could grow their mortgage to 20%, it means we'll be adding close to about $80 billion to our GDP, which will be considerable and will bring a lot of economic activity that we will need for the country to grow. I heard the Mofi people are listening.
Thank you very much. If I may just stand and share a little experience. Recently, the board of directors of Family Homes Funds, where I worked before moving on to Mofi, paid a visit to Morocco. And you'd ask, why go to Morocco? The result we came back with was that the Moroccan government has at this point practically satisfied the need of social and affordable housing. And they are now moving on to luxury housing for its citizens. The single critical catalytic factor was that they set up an institution that provided guarantees to the financing institutions, which then were able to provide mortgages for 20, 25, and 30 years for both the public and private sector workers. This was the lesson that we learned. So I do agree with Rupa that the positioning of institutions such as NMRC, and what I took from his presentation today was that unless the financing institutions in Nigeria have the capacity to lend across board to government workers, private sector workers, it will be difficult to drive mortgages up and that penetration that will help the relationship with the GDP. So for us in Ministry of Finance Incorporated, our responsibility would be to drive government policy in this regard. 1. 2, see what intervention we can do in the light of what we plan to do, set up a Ministry of Finance Incorporated real estate fund. And that is in the works at the moment. Thank you.
Thank you very much for those contributions and the question as well.